You clicked on this video because you are 21 years old and ready to start investing in index funds. That advice sounds perfect until it fails you when market volatility hits or high-interest debt piles up faster than your portfolio grows. Most young investors skip the foundation, buy into a system they do not understand, and end up selling at the worst possible moment because of behavioral friction. Today, I will show you why building a personal financial roadmap must happen before you ever click that buy button. The standard advice for someone in their early 20s is to immediately allocate every spare dollar into broad market index funds. The logic relies on compound interest, suggesting that time is your greatest asset and delaying entry costs billions of dollars over decades. This mathematical truth holds up perfectly on paper when we assume a perfect investor who never panics and has no financial liabilities. However, the real world operates under different rules where human psychology often overrides mathematical advantage. When you ignore behavioral friction and debt optimization, that theoretical compound growth becomes irrelevant because your actual net worth trajectory is destroyed by other forces first. Consider the immediate erosion of wealth caused by high-interest debt before we even talk about stocks. The Securities and Exchange Commission explicitly notes that successful investing requires a personal roadmap assessing risk tolerance and goals before purchasing any securities. This regulatory guidance implies that skipping foundational steps leads to suboptimal outcomes because you are treating a complex life situation as a simple asset allocation problem. If you carry credit card debt at 20% annual percentage rate, every dollar invested in the stock market is immediately fighting an uphill battle against a guaranteed negative return elsewhere. Here is the thing about high-interest liabilities that most beginner guides ignore. A 25-year-old with $3,000 of credit card debt and zero emergency savings faces a mathematical certainty where their net worth declines regardless of how well they pick stocks or which index fund they choose. The nonlinear cost of borrowing money means you are effectively paying an interest rate that the stock market cannot consistently beat on a risk-free basis. You might earn 8% annually from your portfolio, but if you pay 20% in credit card interest, your net financial position is moving backward at 12% every single year. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This creates what researchers call behavioral friction, where analysis paralysis sets in regarding index fund selection rather than actual market timing. Young investors often spend months researching the best funds while their debt compounds faster than any potential return could ever match. The psychological stress of watching a credit card balance grow exponentially triggers anxiety that makes anyone, regardless of age, hesitate to invest further or sell assets during dips. Without first securing an emergency fund and eliminating high-yield liabilities, this anxiety becomes a permanent feature of your financial life rather than a temporary hurdle you overcome with preparation. Let us look at how the engineering mindset applies here by treating cash flow as a system architecture problem that requires specific layers before deployment. You cannot build the roof of a house without first pouring the foundation and framing the walls, yet many 21-year-olds try to install solar panels on an unfinished structure. The bottleneck in your financial system is often not low returns but high-interest debt or lack of liquidity. Optimizing this bottleneck means eliminating liabilities that guarantee negative returns before deploying capital into volatile market infrastructure where returns are probabilistic. The primary failure mode for beginners is not poor asset selection, but the absence of a personal roadmap to define risk tolerance and emotional triggers. When markets drop by 10%, 25%, or even 30% in a single month, investors without a buffer often liquidate their assets out of panic rather than logical rebalancing. This premature selling negates all benefits of having a long time horizon because you exit the market right before recovery happens. The data from studies on financial literacy suggests that participants who lack this roadmap are significantly more likely to abandon investing entirely after one bad year, regardless of how well their portfolio performed in subsequent years. Practitioner perspectives highlight that without first securing an emergency fund or eliminating high-yield liabilities, the psychological stress of market volatility often triggers premature selling. This is not about being greedy or impatient. It is a survival mechanism where your brain perceives financial uncertainty as a threat to basic security. When you have no cash reserve for emergencies, every dip feels like a disaster rather than an opportunity because you cannot afford to wait out the storm. The stress of potential bankruptcy from unexpected expenses forces you to sell investments at a loss just to cover daily living costs. Successful young investing requires a debt optimization phase where you engineer your finances to create a firewall against these pressures before buying any stocks. This means prioritizing high-interest credit card repayment until that 20% drag is gone, then building an emergency fund covering 3 to 6 months of expenses. Only after this foundation exists does the math shift in favor of immediate market entry because you have removed the variable of forced liquidation from your equation. You are no longer fighting a war on two fronts where debt eats away at gains while markets fluctuate around you. The trade-off involves balancing long-term growth potential against immediate wealth erosion, and this balance shifts dramatically depending on whether you carry high-interest liabilities or not. If you have no credit card debt and a solid emergency fund, then the compound interest argument becomes powerful enough to justify starting immediately with index funds. But if those conditions are not met, every dollar sent to an investment account is effectively wasted because it could be better used as a shield against financial ruin elsewhere. The goal is not just growth but net worth preservation through strategic ordering of operations. This approach reframes investing from a binary event where you simply click buy into a system architecture problem requiring specific layers of security first. You are building the infrastructure for your future wealth, and that foundation must be solid before you add any volatile assets on top. The failure rate among beginners who ignore these steps is high because they treat their financial life as an investment account rather than a holistic ecosystem where cash flow management dictates everything else. By addressing behavioral friction and debt optimization first, you create the psychological stability required to actually hold on to your investments through market cycles. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.